All right. Well, we can go ahead and get started. We don't want to
Perfect.
take any longer than we need to. I want to thank everybody for hopping on the call today. And Christy, thank you as well for being the main speaker on our 2017 Impact series. I'm super excited to be here. I do hate being off camera. I mentioned to Christy earlier, I am actually battling a little bit of the flu today. So I've got about 5 or so minutes in me to introduce and do housekeeping, and I'll be keeping an eye on the chat. But this is really Christy's show, and I'm super excited for the conversation today as Christy had put together the pricing playbook and building profit into every sale. And so this is going to be really her conversation around this topic, which I'm super excited about. For everybody that's on the call, we have the webinar chat open. We do like having an open dialogue, asking questions. So if something pops up, I'll be here to interject as we're going through the conversation. So please don't hesitate to reach out. It looks like we've got a lot of new faces to the Impact series. I just want to let everybody know this is an ongoing series that me and my firm put on, and it's really designed for business leaders who are looking to create lasting positive change in their organizations and the organizations that they work with. And I really enjoy getting experts on a call like Christy to walk through challenges and opportunities that are shaping today's workplace and providing you with actionable tools to really help strengthen your business and the people within your organization. Um, I think really the key takeaways that when we were working through this, Christy, that I was excited to hear about is, how profits drive long-term success and really how that pricing component sends a signal to buyers of who you are. I thought those were really two key takeaways that I'm really excited for us to dig in today. And for those that don't know Christy, she is the owner of Victory Advisory Services. She's got a wealth of experience from the CFO seat that she sits in, and not only somebody that I would consider an expert and go-to person that I trust, but a very dear friend. And so I wanted to thank you, Christy, for taking the time here today. And I'm going to turn the floor over to you.
Thank you so much, Will, and I'm so sorry you're sick, friend. That's awful. Awful,
That's
awful.
all right.
Okay, it's 6 o'clock on a Friday, and I am starved. The doorbell rings, and the pizza delivery guy is there. I am so happy for that box of pizza because I am so hungry. I also have my 3 teens in the house. So I do what every good mom does. I call my teens down to get some pizza. I'll eat last. I'm the mom. What do you think happens? How much pizza is left for me? They're hungry, they're fast, and what do I find? An empty box. Can you relate? Do you have teenagers? Have you had teenagers? Well, that's what would happen to me with my pizza. But that's how business works too. If you don't take your slice of profit, like taking a slice of pizza out before you let the teens devour the rest, if you don't take your slice of profit first, intentionally, it often disappears. Even when you're booked, you're growing, you're hitting record revenue, it is still possible that there's nothing left at the end of the month. And that is super frustrating. It's not what we're in business for. Profit is so important to a successful business. And we are fixing that today, my friends. My name is Christie Varner, and I'm a fractional CFO known as the Profit Improvement Strategist because I have had over 3 decades behind the scenes of $5 to $50 million businesses, getting to help them increase their profit, take control of cash, and use their business to create a life that they love. And profit is really key to that. Our goal is to turn overwhelm into clarity and pricing into profit. This talk today is not going to be about spreadsheets. or fancy accounting or finance jargon. That's not my style. It does not need to be complicated, you guys. This is going to be about real world, simple strategies that actually work for growing businesses like yours. By the time that we're done today, my goal is that you'll have a clear and simple pricing playbook, one that you can use to spot where profit is leaking, build it back into every sale, and third and key, do it in a way that supports your team and scales your growth. Whether or not you're the one setting prices, you'll leave with insight to lead your business or in your role with confidence. I hope y'all are excited. Let's dive in. Let's be real. Profit doesn't magically show up at the end of the month. You have to plan for it. I tell my clients all the time, hope is not a strategy. If I could get paid for saying that, I would be rich. Hope is not a strategy. It's like in my pizza example, waiting till everyone else gets their slice and seeing if there's any left. That is not a plan with hungry kids, and it is certainly not a plan for business. That would be wishful thinking. If you've ever looked at your P&L after a busy, successful month and still felt disappointed, this may be why. Pricing isn't just about marketing or sales. It's a financial lever. It impacts your ability to hire, to grow, to reinvest, and to reward your team. All things that we want to do, right? So let's shift. Let's have a mental shift right now from hope as our strategy to intention, and make sure that profit is baked in from the very beginning. Now, here's what makes this even trickier. Many of you are doing a lot right. Your revenue is growing. You're so proud of that. You have a solid team, great culture, and the product or service that you are offering to the world is awesome. Something to be proud of. And that, my friends, is something worth celebrating. The stats on staying in business are not good. We know that. So please hear me that I am celebrating alongside with you. I just want to give you some tweaks to make it even better. Because sometimes, even with all of those things going for us, profit, it's not keeping pace. And usually, it's not because you're overspending. Yes, overspending is a thing to look at, but often it's because pricing, which is the foundation for profit, is cracked. Not broken, not hopeless, just cracked, and often in ways that no one really notices until the money is slipping through. Now, we know here in Texas that our soil is terrible, right? And so you may look up at your ceiling and notice those little tiny cracks, and you think nothing of it until the day that the front door doesn't shut or the driveway has a crack in it. Wonder how I can give those examples? Yes, we have had foundation repair, and foundation repair is expensive and it disrupts your life, right? So a crack in our pricing costs us money. But good news, it's fixable. Same as the foundation. Our home's all fixed up now. Everything's good. Front door shuts. The good news is it's fixable. Pricing is actually one of the fastest, clearest, fairly simple ways to steer the ship back toward profit without cutting costs, without shrinking your team, and without overworking yourself. And whether or not you yourself set pricing, you influence it every day. So today, we're going to put some tools in your hands to spot those cracks and to fix them. Are you leaving money on the table? If you walked by your kitchen table and you saw a $50 bill sitting on the table, I hope you'd pick it up and put it in your purse or your wallet. It's probably your $50. Who else would have left a $50 bill on the table? I love talking about money on the table because what that implies to me is simple things that we can do, money that we can pick up without going to a lot of effort. So what I'm going to share today are 5 really common pricing pitfalls I see, even in businesses that are growing and have a great team. So none of these mean you're doing it wrong, but shining a light on them can help you keep more of what you earn. And that's the goal, right? The goal for successful businesses is to be profitable. So the first one is I see cost-based or competitor-based pricing. So what that means to me is that you're either looking backward or you're looking side to side. I call that with my clients being a bobblehead. Do y'all remember bobbleheads? That means that we are too focused on other costs. What it costs you is important, and what someone else charges is important. But it doesn't always reflect the value that you bring to your clients. So that is one way that we can pick up some profit by pricing for that. And we're going to talk more about that one later. The second is undercharging for high value work. Sometimes we are solving complex problems or saving a client a bunch of time, adding expertise they didn't have access to, and we have priced it like it's a routine service. So we're giving them something up-leveled and we're pricing at just our regular everyday prices. That's a missed opportunity. That is money left on the table, my friends. The third is no regular price increases. Your costs go up, but prices, often they don't. Even small planned price increases can make a big difference to your bottom line. And we're going to talk more about that in just a second. But let me just say, we all know that costs go up. You cannot talk to someone about the cost of groceries without someone talking about the price of milk or the price of eggs, right? And if any of you have gotten your home insurance premium info in the mail, oh my goodness, did ours go way up this year. Well, so in our personal lives, we know like all of those things cost more money. And if our salary stays stable and our costs to live go up, what happens? We just have less disposable income to spend, right? It's exactly the same in your business. So think about the costs in your business. If you have employees, you know that your health insurance costs have gone way up. I've seen it across the board with all of my clients. Health insurance just costs more, but you may also find increases in what it costs to hire someone or in your tech stack or whatever services you're using. You have vendors that have increased their cost to you. And you're like, well, that's fair. I know everything's going up in price. And yet you haven't planned any small price increases. And so what's getting squeezed? Profit. That's money left on the table, my friends. The fourth one is pricing on gut. We've all been there. I've done it myself. We price in the moment, feeling rushed or going with what feels right. But your gut is important. Instinct is important. I'm just here to tell you that instinct plus data equals way better results. So you'll make better decisions if you know the data ahead of time, and then your gut will be well informed when you make that in the moment decision. And then the fifth is sales and finance not being aligned. Misaligned incentives really mess you up, but it's really normal. Sales wants to close the deal. That is how they get paid. They get paid on quotas, they get paid for yeses. Finance needs the margin. That's what we're looking for. So if those two aren't in sync, you can end up with work that's busy, but not profitable. If any of those are hitting home for you, please know you are not alone. It's really normal. It's like the money on the table. It's just something we haven't really noticed. We may walk by the money on the table 10 times and not notice it. Now that you notice it, you can keep more of what you earn. These are all fixable. I want to share with you now the power of 1%. This is one of my favorite things. So I'm hoping that this is a big takeaway for you. It's a little math I love sharing with clients. And it's really simple math. If there are those of you who are like, oh my gosh, I hate math, that's okay. I really hate hard math also. So if you raise your prices by just 1%, 1%, your profit could jump by 5 to 10% with no extra work. Let me say that again. If you raise your prices by 1%, your profit could jump by 5, even 10% with no extra work. Why is that, Christy? Because most of your costs in your business are fixed in the short term. Your rent stays the same, no matter how much you sell. Your payroll, the money you spend on trucks, the money you spend on your tech stack, your services, all of those things, for the most part, they stay the same. So when you raise prices and you don't lose volume, and let's be real, if you increase your price by 1%, you're probably not going to lose very many customers. I don't think many people are even going to notice. So let's just say that you raise prices and don't lose volume, your costs don't change. Most of that new revenue drops straight to the bottom line. So to illustrate it, let's just use simple numbers. Let's say that you're running a $10 million business with a 10% profit margin. So that means on the $10 million in revenue, you are keeping $1 million of what you've earned in profit, which is awesome. I love that. So now let's just say we raised prices by 1%, which gives us an extra $100,000 in revenue. So now we're a $10 million, $100,000 company. It doesn't even seem like much of a change, right? But we have the same costs and the same team. So that extra $100,000 drops straight to the bottom line as pure profit. So where we had $1 million in profit just moments ago, we have now added $100,000 to that profit. That is a 10% lift in profit from a 1% price change. 10% profit lift from 1% price change. But you may be saying, oh, Christy, we do not earn a 10% profit margin. Our profit margin's lower. Say it's 5%. Well, first of all, I love working with people like you because, like I said, I love to improve profit. And in many industries, 5% is lower than it should be. But let's just say that you're at a 5% profit. On $10 million, you're keeping $500,000. Still a really nice number, right? So in our scenario, we're still going to raise prices by 1%, not lose any volume, keep the same cost, keep the same team, right? $100,000 more in revenue. Now, when that 100,000 drops through to the bottom line, we've added 100,000 to 500,000. Guess what that is? That's an even bigger lift. That is a 20% boost. I hope that that is like sinking in for you guys. This is one of my favorite things. It's such a small thing. But let me just tell you, here's the kicker. We just talked about 1%, right? You may not have raised your prices in a while. Let's just say that you raised your prices by 3 to 5%. A 3 to 5% price increase can have the same impact on profit as growing revenue by 15 to 20%. Do you guys know like how cool and how big we celebrate when we have a 15 or 20% year-over-year growth in revenue, right? That is so awesome. Totally celebrating. But let me tell you, your revenue number is cool. It's kind of like your Facebook picture of like, oh, this is all that. And you can tell people at, a cocktail party or a networking event that you've grown by 20%. But really, the reason that we care about a growth in revenue is because of the impact that it has on profit. Because revenue is cool, but really that's just our vanity metric. Profit is what we're after at the end of the day because we have to be profitable to stay in business. And even more so than that, profit, I call it being a profit pro. All my clients know that, and it's one of my favorite little acronyms. So it's PRRO. You want to be a profit pro. The reason we care about profit is because P, it gives us the cash to pay the taxes, right? No one likes paying taxes, but it's good to just have the cash. The second R is reinvest. You need to reinvest in your team. When you're ready to grow and scale, you need money to have to fund that growth. You need money for a mastermind, new computers, new tech, new trucks, whatever that is. You need cash for that. It comes out of profit. You need money for rainy day. If pandemic taught us nothing, it certainly taught us that you cannot predict when something will go wrong in your business, and you need to have money set aside for rainy day. And then O, I call owner's choice. You as an owner took the risk of having this company, so therefore you get the reward. And you may decide to pay down your home mortgage with that reward. You may decide to take your team on a retreat. Whatever it is that you decide, that's the fun of it. So you want to be a profit pro. So at the end of the day, that profit is what tells us that we have a successful business. So imagine that you could increase prices by 3 to 5% and get the same profit impact as growing by 15 to 20% in revenue. We all know a growth of 15 to 20% in revenue is a big deal, right? So you may even be able to combine those two together, right? 3% increase in price and a 10% lift in more volume of sales. Huge impact on profit. So I just want your mind to start clicking through all the possibilities that a tiny tweak to price can have. That is some serious leverage. You don't have to overhaul everything. You just need to price with intention. A small change in price can cause a big lift in profit. I hope that has you excited. That's one of my very favorites. Okay, pricing though is not just about math, it's messaging. Your pricing sends a signal to the world about who you are as a business, what kind of experience your clients can expect, what kind of clients you are serving, and where your brand fits in the market. It's the difference between a bottle of water at Walmart and a bottle of water at a Mavs game. I'm a big Dallas Mavs girl. Same product, totally different price. Why? Because the experience is different. The availability is different. Everything is different. When your price lines up with your brand and your value, and we're going to talk more about the value in a minute, that's when everything clicks. You attract better fit clients and you repel the wrong ones. I know that's scary to send away the wrong ones, but it actually is very helpful to our business and it's helpful to our profit. And what it means is then your team gets to deliver the kind of work that they're proud of without being overworked. You aren't just running a business, you're building a brand. And pricing is one of the most powerful tools that you have to tell that story well. So, I want to break down for you a simple but powerful method I use with clients when we talk about pricing. It's 4 steps, super simple. It's how you price with intention and not just instinct. Remember, we talked about that? Yes, have your instinct, that does matter, but also have a model that you're following. So, step 1 is you're going to start with your fully loaded cost. Yes, that means your labor and materials, but also there are more costs for a fully loaded cost. And we're going to dive into that in a minute in a little iceberg slide that I'll show you. So let's move on to step 2, and that's add your profit margin target. I want to pause right there for just a second, because if you don't build profit into the price up front, you're just hoping there will be some left over. It's like my pizza story. If you wait for the hungry teens to leave you a slice, good luck. You need to take your slice of pizza first. It is the same with pricing. Margin does not make you selfish, it makes you smart. If we aren't profitable, we are simply running an expensive hobby. I know that's a hard truth, but friends, it is the truth. If our business is not profitable, we are running an expensive hobby. And it's taking a lot of time and energy, right? It's sucking a lot out of us. We're giving a lot to our business. So it needs to be profitable. Step 3 is adjust for client value. This one, we often overlook this. What's it worth to your client? That is a multiplier of what we can charge. And it's so important that I'm going to do an extra slide on that one. And then the fourth one is capacity check. This is really important, and we often don't do that. But can your team deliver at this level and still breathe? You don't want to price for volume if the volume is going to break your ops team or overextend your people. It's okay to charge more and serve fewer clients better. Let me say that again. It is okay to charge more and serve clients better. You can actually even be more profitable doing it. You're not trying to just be busy. You're trying to be profitable, sustainable for your team, and scalable as a business. So when I say price with intention, I mean building in margin and protecting your team and aligning to value. So let's talk about those hidden costs that kill profit. We all think of cost as the direct costs, the materials and labor, what's visible above the surface in my little iceberg. But below the surface, every great business leader knows there are real costs that go a lot deeper. Things like rent, software, insurance, payroll taxes, your amazing admin and ops team, the time and effort it takes to get a sale, the cost of risk. That is a huge one that often doesn't get factored in. The cost of rework, a cost of a client who churns, the risk and the cost associated with the risk of things that just go wrong in business, and all the little things that add up when no one's looking. My friends, none of these things are extras. They are part of doing business well. If your pricing only covers what's obvious, you will end up covering the rest. But you know where it will come? Out of your profit. And that means that you're doing everything right, but still coming up short. You're not bad at this. You're doing a lot right. Now it's just the time to make sure that your price covers the full picture. So when you start pricing something, take into account the full truly loaded cost. Yes, start with your direct cost, but then add in an amount to cover for all the back office and overhead and risk that you need to cover in order to keep this business going. After that, then you add your profit margin. Oftentimes I ask a business owner, what profit margin are you targeting? And they look at me blank. That's when I know that we have hope as a strategy. You've got to know a percent that you want to get. I do see a lot of people do that right. I see a lot of markup. So start with that true, fully loaded cost and then add your profit margin target. Now let's talk about the third thing. Sell the result, not the recipe. This is a common pricing mistake I see, and I love it because, of course, it's also easily fixed. It's just a mindset change. So a lot of us would love to have an apple pie, right? Sounds really good. Warm, crumbly apple pie sounds fabulous. Or would it be okay with you instead if I just gave you a bag of apples and some flour and some sugar and some baking powder? Good? Y'all good? Butter, I'll give you all that. You good? No. You don't want that. You want the warm, crumbly apple pie, right? That I just promised, hot out of the oven, maybe some ice cream. A lot of us in businesses price like we're handing out a recipe. We line up all the ingredients, labor and materials, and then we mark it up a little bit, right? But the best businesses price like they're delivering a result. Like that somebody wants to buy the apple pie and not just a combination of all those ingredients. So I'm going to give you a little example of what that looks like in the business world. So let's use a commercial janitorial company as an example. So they don't just mop the floors and empty the trash cans. They do that, absolutely, for sure. That's what they're paid for. But what are they really delivering to their client? What's their client really after? Peace of mind. Clean, safe, professional looking spaces that reflect well on their brand, right? That's what they want. That's what they want to pay for. So you may have a prospective client that sees the service as a simple cleaning expense, right? But maybe there's another prospective client, maybe they're a high-end medical practice or a Class A office building, and they value not just the cleaning, but they value that your business brings them reliability and consistency and attention to detail. That's an add-on. That's worth more. So when you price based on the outcome, not just what you do, you stand out. You serve better clients and you earn the margins that you deserve. Because let's be real, your clients are not buying your mops and your manpower. They're buying what it does for them. They're buying that apple pie. So after you price for your true fully loaded cost and you add your profit margin, then stepping back and evaluating the value to someone else. I literally just had this same exact conversation with a client not an hour ago about the value to their clients for the service that they're providing. Considering that, you may change your price. You may be able to reframe your offer and highlight, in our example for the commercial janitorial company, the fact that what differentiates you is your attention to detail and your consistency and reliability. And that's something that this prospective client really values. It's part of the apple pie that they really want, and they'll pay more for it than they will for just a simple cleaning service that can't provide that. So, something to think about. Here's something I see even in really successful businesses, especially those that care deeply about their customers, and I bet you're one of those. I am, I know for sure. You might accidentally be giving away more than you realize. Not because you're doing anything wrong. It's usually just a blind spot that you haven't seen before. But I want to shine a light on that and just give you a few red flags that might mean that you're quietly subsidizing your clients. And these are kind of tricky to spot. So the first one is really weird. You're like, oh, we're always busy. However, profit is still tight. That could mean that your pricing isn't keeping up with what it really takes to deliver. Busy but tight profit is not our goal, and it may point to a pricing problem. The second one, this is a funny one because you're like, no, this isn't a problem, Christy. Nobody pushes back on price. I mean, it sounds great, right? Wouldn't we all love to close every deal that we walked into? I certainly would. But it might mean that you are pricing below the value you're providing and leaving money on the table. It might be just like that example that we talked about. We're pricing too low because we have not considered the value that we're providing to the client. And we're going to talk about that a little bit more in an illustration later. The third is discount to close. So you've gone through the pricing model, you've marked up your true fully loaded cost with your profit margin, you thought about the value to the client, you did the capacity check, and you feel good with this price. You went with your gut and the pricing model, so you had instinct plus data, everything's good. And then what do? You discount to close. We've all done it. I'm not coming down your street in a way I'm not coming down my own. I've done it also. But a great client shouldn't require a discount because if it's a great fit, they should see the value. We should have priced it right for the value. So we don't need to quickly default to discounting to close. Sometimes we just need to be silent and let the prospective client take in the value of what we are providing. Sometimes we jump in fast with a discount to close. And then the fourth one, scope creep. Oh my goodness, we all know about this. Scope creep happens and we absorb it. I mean, all of us have worked a little bit beyond scope at times. I certainly have. I know it's really common. But if you avoid charging for out of scope work to keep the peace, you're taking the hit for a client decision. The client asked for more, and we didn't want to have that kind of uncomfortable conversation. And so now our profit is taking the hit. And honestly, our team too, because they're having to work extra, which is no fun to do to your team. So these things don't show up as like one big crisis. They kind of sneak in, and you'll see it as burnout of your team or as tight cash, or simply wondering, why does it feel like we're doing everything right, but profit is still not showing up? I thought we did this right. I thought we were going to be profitable. It's so frustrating, you guys. So frustrating. But this is why I'm excited to share these things with you, because I hope that you are starting to grasp that there are ways to change this. It really doesn't have to be that hard. You are already delivering amazing work, and I am so proud of you. So now our goal is to make sure that your pricing reflects that. Let's be real for a second. Underpricing is not a math problem. It's an emotional one. We think we're being logical, tweaking numbers, staying competitive, but most of the time it's just fear talking. Fear of losing the deal, fear of being told we're too expensive, fear of rejection, plain and simple. Again, I get it. I also do not like to be rejected. But here's the truth. If you're delivering real value, your price should reflect that. You're not selling on price alone. You're selling those outcomes, the apple pie. You're selling outcomes, service, experience. So let's stop letting fear run the show. Let's commit to that, okay, my friends? Let's commit. Stop letting fear run the show. Say your number and close your mouth. Be silent. If you have priced everything correctly, your client should see the value in it. Do I want to pay $7 for water at the Mavs game versus 50 cents at Walmart? No, but do I see the value in paying the $7 because it's the only way that I can get the outcome I want at a Mavs game, which is that bottle of water? Right. You are offering a great product or service with a fantastic team to the world. Stand firm in your pricing once you have priced it out correctly. Don't let fear run the show. The worst that can happen is they say no. What if we have to rework it? What if we have to rethink it? Pricing is a business decision, not a popularity contest. Many of you want to scale and grow your business or exit in the next few years. You cannot scale or exit what you underprice. This is something a lot of business owners miss. So let's first talk about scaling. You can't scale what you underprice. Not because you don't have the team or the drive, but because scaling takes investment. And that investment usually kicks in before the growth kicks in, which means in math that you have to spend money before you get the revenue growth. So it's really not revenue doing this. What happens is you spend money and your revenue doesn't get impacted yet because you have to hire more people and more systems and more delivery capacity before you get that revenue growth. So what happens is your profit margin goes down. Well, you have to fund that next level of more people and more systems and more delivery capacity. Where are you going to fund that from? You cannot fund it from thin air. That next level has to come from somewhere. Banks won't loan to you without strong profit, right? If you think you're going to raise capital, you want investors. Well, investors are not going to invest without profit. Or what if you're going to self-fund it? We talked about being a profit pro. you have to have that profit left over to reinvest in your business. So that's where that cash comes from. So your own cash reserves will only take you so far. So you have to price right so that you can scale. That pricing leads to the profit that allows you to scale. And you definitely cannot exit without profit. I know there are so many businesses right now starting to think about an exit transaction in the next 3 to 5 years. And I love working with those businesses. I've been on both the buy side and the sell side. And let me just tell you, it's a completely different strategy that we take from a financial standpoint 3 to 5 years before we want to exit, because there are just different things that a buyer will be looking for. Let me give you a clue. Buyers do care about the top line. They do care about your revenue. But I'll tell you what they actually care about is the bottom line, right? They care about your profit, because if you are running a really successful $20 million business and it costs you $20 million to run it, who wants to buy that, right? They want to buy a business that has profit. And the multiple of what they're going to pay is based on that bottom line. Profit drives valuation. Profit is what gives you options to hire ahead of the curve, to invest with confidence, to negotiate from strength in an exit. You're already doing the hard part, building a solid business. Don't let underpricing quietly hold you back. I know some of you might be thinking, this is all great, Christy, but I'm not the one setting prices. Totally fair. Not everyone on this call owns pricing. I get that, but let's be honest, you still feel it. If you run ops, you're the one trying to deliver with tight margins that don't reflect reality. If you lead a team, you feel it when scope creeps and the price does not. And if you're in finance, you see the shortfalls and you are scrambling to make it all work. Here's the thing, my friends, pricing is a team sport. It might start in sales or with the owner, but it doesn't end there. The ripple effect shows up everywhere throughout the business. But that's actually good news, because you don't have to be in charge of pricing to influence it. So if you're not in charge of pricing, I want to give you just 3 ways. I could give you a million ways, but here are 3 ways that you can make an impact. The first is to notice margin leaks. So if you see a type of job that always takes longer or requires rework or is just draining to your team, say something. The people who are pricing it, who are trying to go through that pricing model, might not realize the risk of rework and the drain on the team, that they put the wrong number of hours in for what it's going to take to do this work. That's not just an ops problem. That is a pricing red flag. The second is to connect effort to value. You're close to the work and you are the one that knows when something should be a premium priced service, right? You're like, whoa, this is not routine. And yet we priced it routine. That insight is gold. It could lead to new pricing or a value add. It's insight that you have because you're close to the work that the person who sold it might not know. The person who helped set the price might not realize. The third is to raise capacity concerns. Remember, we talked about the capacity check. They might not know that your team is burnout doing low margin work. And I'll tell you what, that is not sustainable. You think it's a staffing issue, and it is, but it's not just a staffing issue. Pricing is part of the fix. So if you've ever found yourself saying like, oh, I don't think we're charging enough for this, it's good news. You're already noticing what matters. Don't stay silent. Don't stay silent. Your insight could be the key to protecting the margin, to keeping your team sane, and to helping the business grow well. Remember, pricing is a team sport. There are a lot of things I watch for as a fractional CFO, but I want to just share 4 things I always keep my eye on when it comes to pricing and profit. You don't need a finance degree for these, they're pretty simple. The first is gross margin by line of business. So oftentimes people just look at their business in total. But instead, I encourage you to look at the different divisions within your business. It might be by product line or service or division or whatever. Is there a part of your business that makes more profit than others? For example, you might think that you're a remodeling company. You might think that both your kitchen and your bath remodels are equally profitable because you price them that way. But once you dive into how each of those are doing, you might find that one of them is quietly leaking profit and you had no idea. So you want to look at the patterns across those different divisions, services, product types, customer types. The second is contribution margin per crew or project. So now we're going a little bit deeper even to the crews themselves, the teams themselves that back up each of those lines of business. That helps us see when you have who's pulling their weight, who needs more training, right? Even if your overall margins look good, you may have a team that's consistently dragging things down, and we'll never see it unless we break it down like this. The third is labor efficiency ratio. I learned this from Greg Crabtree, and it's one of my very favorite tools, and I use it in a lot of different ways, but specifically as it relates to pricing. This shows how much gross profit dollars you get for every dollar you spend on your team. So there are a lot of insights you can get from that, but one is that it's one of the clearest indicators of healthy pricing and delivery. If it's too low, it can mean a lot of things, but one it might mean is that more than a staffing issue, you may have a pricing issue. And then the last one that I wanted to share is win-loss insights from pricing. This is where the finance and sales team really need to talk. If you're winning too easily, you might be underpricing. If you're losing often on price, we're always like, oh, we just lost on price. That's the time to dig in. Is it perception? Is it value? Is it communication? Are we targeting the right people? I love asking, are we losing to better pricing or better positioning? Just some things to think about. I wanted to walk through just a little example of what it can look like to price for profit, not just price to sell. So let's just use an example where you're charging $6,000 for a service that costs you $4,800. So that's a 20% gross profit margin. At that level, you're booked solid, but also your team is exhausted, near burnout. And even with all that work, your net margin is 7% in an industry where the average is closer to 10%. So you know something is wrong and you're not happy about it. So what do? You go back to our pricing model and you price with intention. So you rework your pricing strategy. You look at what value you're delivering and then you reframe your offer. So let's just say that you go, I think we could raise the price on that to $8,500. Well, you might think, Chrissy, we are going to lose some customers if we do that. Yep, you might. You might. But the ones you keep, the ones who stay, will be better aligned, easier to serve, and more profitable. And what will that pricing change do? It will free up capacity, give your team breathing room, and actually increase profit. You didn't have to hustle any harder. You just had to price smarter. So sometimes even losing clients when you change your price dramatically because it's just the wrong price to the value, still makes sense. It still might make sense to your team, and it still might make sense even to the profit at the bottom line. Here's something that doesn't show up on a P&L, but has a huge impact. Your pricing sets the tone. Your pricing sets the tone. If you discount or price just to get the deal, which we've talked about, we've all done, guess who you tend to attract? The clients who are all about the bargain. And those clients, they usually want more than they paid for. They're often hard to work with. Sometimes they're slow to pay and they're wearing your team out. I think we have all worked with clients like that before, so we know a discount buyer is very different from a value buyer. When you price on the real value that you deliver, you draw in the clients who respect your work, who really want that value. They want that homemade apple pie instead of the little Debbie pie in the bag from Walmart, right? They're willing to pay more for the homemade apple pie. They follow your processes, they're easier to serve, they stick around, they pay on time. And what difference does that create? Your team feels the difference. When they know that their work is priced right, they show up with more confidence, pride, and energy. They are not overworked. They have capacity. So, yes, pricing affects numbers, but it also shapes how people behave, how your team feels, and how your business grows. That's the ripple effect of doing pricing right. As we wrap up, I want to leave you with 3 small but powerful ways that I've seen owners boost profit without overhauling the entire pricing model. My goal is for you to leave here with an actionable step. So here are 3 examples, but you may take one of these 3 or something else I said earlier or a combination of something. My goal today is not that you would just get information in your head, but that you would instantly try to apply it. What's the worst that can happen? Right? Figure some things out, try some things. We learn so much from applying and trying. So here are 3 choices. One is to raise prices on low margin work. These jobs feel productive because they're keeping you busy, but often they're draining time and talent without giving you a strong return. So on those low margin jobs, you can raise prices 5, 10% probably. Go back and look at them. Get those low margin jobs to add to your bottom line of profit. We already saw the impact, like raise the 1% on every single thing. You'll see the impact of that. But even if you just want to take just a segment and raise it, that will add. The second is to add a premium service. There is always a client who will pay for faster, better, or easier, and they want that. Give them the option. If I want to have a delivery from Amazon by 5 o'clock tonight, they'll bring it to me for free. If I want it between 4 and 8 in the morning, $2.99. Did that cost them any extra? No. It just meant that my thing had to go on the front of the truck and I had to be on the front of the delivery schedule. It didn't cost them anything, but it just dropped that $2.99 straight to the bottom line for them, right? There's always someone who will pay. Or there may be a white glove service that you can offer. And then the third one is offer tiered pricing. People love options. Not every client is going to need your full package. So let them self-select what matters most. The sales psychology is that you should offer 3 packages, and they say they'll anchor on the first one. So you offer the most expensive one first. And then, 2 and 3 seem a lot like the better deal. So that may help you get more businesses if people can self-select. Not everyone wants the one size fits all. You do not have to do all 3 of these. Just pick one smart move and put it into play. Which one feels like the best next step for your business? Which one feels like the best next step for your business? I really want you to think about that. If today's talk has you rethinking how you approach pricing, I would love to keep the conversation going. You can find me on LinkedIn at the QR code on the screen, or at Christie Varner on LinkedIn, or at victoryadvisoryservices.com. We're a fractional CFO advisory firm. I would love to connect with you and to chat about your business and hear about your pricing. I also want to thank Will for inviting me to speak as part of the 2017 Impact Series. It has been a real privilege and an honor. I love meeting new people, and I've really enjoyed being with you. Let me leave you with this thought. When I get pizza for our family and I don't take a slice right up front, I'm leaving it to hope that there will be enough for me later. And with 3 teens, hope is not a good strategy. It's the same in business. We don't hope for profit at the end. We plan for it from the beginning. That plan starts with how you price. Pricing doesn't have to be complicated. It just has to be intentional. My goal is for you to leave with at least one practical idea to try. And when you do, I'd love to hear how it goes. I'll be cheering you on. Thank you.
Thank you, Christy. That was fantastic. And I see some people adding some amazing comments in
Um,
the chat. And so I did want, since we've got 5 minutes, if there were any questions that anybody had that you'd like to have Christy weigh in on here before we take off for the day, we'll leave this open for another couple of minutes. So please feel free to go ahead and enter those questions into the chat. I thought the presentation was fantastic, and I love the 1%
gosh, it's crazy,
pricing
right?
adjustment. Yeah,
1% friends. One.
and how it flows all the way down to the bottom line. It's a conversation when I'm educating employees. That's a anchor that I use, the 1% change to deferral percentages. And I was just like, oh, that resonates because it's a small change,
Mm-hmm.
but it has such a lasting impact if you stick with it over time. And
It
I thought
absolutely
the
does.
illustration of, what that means to the profit margin was eye-opening.
It's one of my
Um,
favorites. Profit Pro.
yeah.
You want to be a profit pro, and it really doesn't. There's so many tiny tweaks that you can do. So many, and they will all flow to the bottom line. I love. I get super charged up. Y'all can probably see.
I love it. Um, and let's see here. It looks like we did have a question come in here from Sasha. I have seen these issues in my own practice, and your approach is going to be helpful. So it sounds like everyone's
Thank you,
just super
Sasha.
amped up
Y'all are so
on
sweet. That's
the
always my
content
goal.
here today, Christy. So thank you.
You're so welcome. That's my goal. You, as small business owners, I just want you to know you are the heroes and the backbone of the American economy. So we can turn off the news and stop being so frustrated with anything we see on the news. You guys just keep focusing on what you're doing because you are making a difference. When you do your business well, yes, your home life and your family life is better, but also you have the ability to impact your employees and your vendors and your customers. And I just applaud you and thank you. And I love getting to share my expertise and experience in simple ways because my tiny little piece, I get to watch the ripple effect that you have on the economy. So I just want to thank every one of you who are running businesses and who are business leaders because it really does impact so many people when we do it well.
I love it. Well, I think that's the best note to end on, Christy. Thank you again for the time. Thank you, everybody, for joining the call today. There will be a recording that will be sent out as well. So if there are people that might benefit from the content here today, please feel free to share. And we look forward to seeing you all again soon.
Thank you guys so much. It was so fun, and I'd love to connect with you. Thanks.
Thanks, Christy.
Bye for now.
Bye.